Everyone knows Warren Buffett is rich, but most people have no idea how he actually gets paid. Spoiler, it's not stock trading. It's a slow, almost boring system built around dividend stocks that generates billions even when the market is crashing. In this video, I'm going to break down how he does it, the iconic dividend stocks that built his empire, and in the end, I'll show you Buffett's most recent buys, which might just become the next Coca-Cola, that currently pay him over $2 million in dividends every day. Now, before we break it all down into complex strategies or big financial words, let's ask the real questions. How does he do it? Why is he so obsessed with dividend stocks? And most importantly, what can you learn from it? Buffett, often called the Oracle of Omaha, doesn't chase flashy trends or the next big thing. He believes in owning solid, profitable companies that return cash to shareholders year after year. His secret technique? Buying businesses that generate reliable profits and then holding on to them forever. And these businesses send him a check in the form of dividends every few months just for owning the stock. Dividends are a company's way of saying, thanks for trusting us, here is your share of the success. For Buffett, those steady payouts are more than just a reward, they're a tool. While most investors focus on price charts and market timing, Buffett focuses on cash flow. And dividends are the most reliable cash flow you can get in the market. Take Coca-Cola, one of Buffett's legendary holdings. He started buying shares back in the late 1980s, and he's never sold. Why? Because every year, Coca-Cola pays Berkshire Hathaway hundreds of millions in dividends. In fact, he's set to receive approximately $816 million in dividends from Coca-Cola in 2025. This substantial income stems from Berkshire's ownership of 400 million Coca-Cola shares, each yielding an annual dividend of $2.04. This equates to around $204 million quarterly, or roughly $2.23 million daily. And those checks keep growing. That's income without lifting a finger. Multiply that by dozens of similar positions, and you start to understand the scale of his strategy. Even better, Buffett uses those dividend payments to buy even more dividend-paying companies. It's a self-feeding machine. Money comes in, and instead of just sitting on it, he reinvests it. This cycle repeats and compounds, and many of these companies are so strong they increase their dividend payouts over time. So Buffett isn't just earning passive income, he's earning growing passive income. So if you're wondering why the world's greatest investor prefers slow and steady over fast and flashy, the answer lies in the quiet, powerful world of dividend stocks. Let's take a look at the core strategy Buffett follows and how it turns steady income into legendary wealth. Warren Buffett once said, "Our favorite holding period is forever," and that's the backbone of his investing mindset. He's long warned against chasing quick wins or bailing out of good companies too early. In one of his iconic letters, he even said, "It's like cutting the flowers and watering the weeds." In other words, don't sell winners and keep losers, do the opposite. Buffett's strategy is almost shockingly simple. Find great businesses, buy them at reasonable prices, hold them for decades, and collect the cash they generate.
To buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
But he doesn't need to sell to make money. He lets dividends do the work. Over time, those dividend payments add up, and when they're reinvested wisely, the snowball just gets bigger. That's compounding in motion. All right, let's bring this all to life in the clearest, most relatable way. Let's say you invest $1,000 in a stock that pays a 4% annual dividend. That first year, you'll earn $40 in dividends. Now, instead of spending it, you reinvest it, buying more shares of the same stock. So now, you're not just earning dividends on your original $1,000, you're earning dividends on $1,040. Fast forward to year 2, your new dividend check is $41.60. You reinvest that too. And now your total investment grows to $1,081.60. By year 3, your investment is worth $1,124.86, and it's growing faster each time with more dividends. That's the power of compounding. Your money earns money, and then that money earns even more. It might seem small at first, but that snowball effect picks up speed. And when you stretch that out over a decade or 3, you start to see why Buffett doesn't need to sell to make money. He just lets the dividends do their thing, and the math takes care of the rest. So why does this pair so well with dividends? Dividends let you benefit from a company's success without selling your shares. Think of it like owning a rental property that pays you every month, but you never have to move out. You still own the property, it still grows in value, and you keep getting paid. Let's take See's Candies, for example. Buffett bought the company in 1972 for $25 million. It didn't become a tech giant or a global powerhouse, but it consistently made money. And because it had few opportunities to grow fast, Buffett took the cash it earned, millions in dividends, and poured that money into other high-return investments. It's a playbook he's followed again and again. To put that into perspective, if John had bought its shares in 1972 and held for the next 35 years while reinvesting the company's copious dividends back into the stock market, he would have turned a $10,000 initial investment into more than $387,000 after adjusting for the effect of inflation. That means $1.9 million in nominal terms. Buffett calls businesses like See's cash cows because they churn out money without needing a lot of maintenance. He loves companies that don't just grow, they generate. And that generation becomes fuel for more investments. It's an upstanding cycle. This method has helped Buffett ride out market crashes, bubbles, and booms with almost eerie calm. While others panic or sell, he collects checks and just waits. And while he rarely talks about excitement, his quiet confidence comes from knowing his investments are working for him even when he sleeps. But how did this play out in the real world? Which dividend stocks turned this strategy into real results? Stick around, because up until now, we saw Coca-Cola paying $2.3 million every day. Well, in the end, I'll show you Buffett's most recent buys, which might just become the next Coca-Cola. Okay, now let's get into the part where Buffett's strategy really shows results. Over the decades, Warren Buffett has turned those investments into dividend machines. Some of the most iconic businesses in his portfolio have paid Berkshire Hathaway billions over the years just for owning the stock, and that's no exaggeration. Let's start with Coca-Cola. Buffett began buying shares in 1988, and he didn't just nibble, he went big. Today, Berkshire owns over 400 million shares of Coke. That's a stake worth billions. Now, Coca-Cola pays Berkshire over $800 million every year in dividends. Back then, the dividend yield on his cost basis was decent, but now it's astronomical because he bought early during a dip in Coca-Cola share prices, and he held on. His yield on cost is now over 50%. This means Buffett is making half of his investment every single year without selling. Next up is American Express. Buffett began investing in Amex during a crisis in the 1960s when the stock was under pressure. Since then, it's grown into one of his largest holdings. Today, Berkshire pulls in hundreds of millions of dollars annually from American Express dividends. And just like with Coca-Cola, those checks keep getting bigger. That's the beauty of long-term investing. You don't just get paid, you get paid more over time. Then there's Procter & Gamble, another consumer giant Buffett invested in heavily through his Gillette acquisition. Though Berkshire eventually exited most of the P&G position, the years he held it provided plenty of steady, growing dividends. These companies all had one thing in common. They sold things people buy, no matter what, like toothpaste, soda, credit cards. Buffett doesn't invest in trends, he invests in habits. The real genius here is the discipline. Buffett didn't jump ship when things were slow. He didn't chase the next hot stock. He planted his capital in well-run companies, let them grow, and let them pay him back. That consistency turned into compound growth. And while it's easy to focus on the headline numbers, the hidden engine here is reinvestment. Every dividend that rolled into Berkshire became capital to buy more stock, and many of those purchases were just more of the same companies. Coca-Cola paying for more Coca-Cola, Amex dividends fueling more Amex shares. It's the investment version of recycling, and it made the snowball roll faster. What's even more impressive is the reliability of these companies. Through financial crises, recessions, and pandemics, Coca-Cola and Amex kept sending checks. That kind of dependability is rare in today's market, and it's a big reason why Buffett has stuck with these names for decades. When people talk about Buffett's investing genius, this is what they mean. It's not about picking winners. It's about building systems that generate cash like clockwork. These were the foundations, the plays that proved the system works. But Buffett isn't just living in the past. The next logical question is, what has he been buying in the last decade? And do those picks live up to the legacy of these dividend giants? So what has Warren Buffett been doing with dividend stocks in the past 8 years? Has he changed his approach? Not really. If anything, he's doubled down, but with a modern twist. The names might be different, but the strategy remains the same. Find companies that throw off reliable cash and hold on for the long ride. Let's start with the biggest and most obvious example, Apple. Buffett began buying Apple stock in 2016. At first, people were shocked. Why would the king of value investing go all in on a tech company? But Buffett didn't see Apple as a typical tech play. He saw it as a consumer brand with an ecosystem so sticky it resembled Coca-Cola, but in the digital age. And while Apple isn't known as a dividend monster, it does pay. And for Buffett, that steady income plus capital appreciation is the perfect combo. Apple's current dividend yield may be modest, around 0.5%, but the scale makes it powerful. Berkshire owns over 300 million shares, and that translates to around $300 million in dividends. Plus, Apple keeps raising its dividends slowly over time, and that's on top of the share buybacks, which increase Buffett's ownership percentage without him lifting a finger. Then there's Bank of America, another giant dividend play in Buffett's portfolio. Bank of America pays a dividend of roughly 2.44%, which translates to more than $797 million for Berkshire. But why does Buffett like it? Because it's a stable bank with consistent earnings and room to grow its payouts. Chevron and Occidental Petroleum are newer but increasingly important parts of the dividend picture for Berkshire. After Buffett shifted more attention to energy in recent years, these oil giants have delivered both capital gains and fat dividends. Chevron's dividend yield is around 4.77%. Meanwhile, Occidental has a dividend yield half of Chevron's, but it has strong growth potential. Berkshire has collected hundreds of millions in cash from these two alone, and with oil prices remaining high, that flow isn't slowing down anytime soon. Let's not forget Kraft Heinz, a stock that's had its share of ups and downs. Berkshire owns nearly 27% of the company. And while the share price has struggled, the dividends have not. The annual yield hovers around 5.7%, and Buffett continues to collect substantial income from it. So how do these modern picks stack up against the old classics like Coca-Cola and Amex? In many ways, they're doing the same job. They provide a reliable cash flow that Buffett can deploy elsewhere. Apple might not yield as much as Coca-Cola, but the dividend income is massive simply because of the size of the holding. Chevron pays more per share than most of Buffett's legacy stocks, and energy dividends tend to rise with inflation, which adds another layer of value. One underrated aspect of Buffett's recent buys is diversification across sectors that still deliver dividends. From tech to energy to banking, he's built a new layer of income streams. These companies can weather storms and still pay investors along the way. And remember, Buffett doesn't just want dividends for the cash. He wants the optionality. Having $1 billion a year coming in means Berkshire can jump on big opportunities fast. It's financial flexibility, and it's part of what's kept Buffett ahead of the game for so long. But what's even more fascinating is that some of these stocks, like Apple, don't even pay high dividends, and yet they're centerpieces of Buffett's empire. That's because to him, dividends are part of the picture, not the entire canvas. Apple might only yield around 0.5%, but its massive reinvestment into innovation and consistent buybacks make it a powerhouse of value creation. Still, when it comes to raw dividend power, it's hard to ignore the billions Berkshire now collects each year. Add it all up, Apple, Bank of America, Chevron, Occidental, Kraft Heinz, and others, and you're looking at over $4 billion annually in passive income. That's more than some Fortune 500 companies make in total revenue, and Buffett gets it all without selling a single share. And while these numbers are impressive, they're not just trophies on a shelf. Buffett uses this income to take action. He's not hoarding cash for the sake of it, he's using dividends as fuel. Every dollar that flows in from Apple or Bank of America could fund a new investment, a private company acquisition, or support buybacks for Berkshire's own stock. That's how the machine keeps moving. Buffett has always said he likes companies that reward shareholders, but the way he defines reward has matured. It's not just about dividend yield. It's about what a company does with its earnings. If a company like Apple reinvests 85% of its profits and turns that into new shares and products that make the company more valuable over time, Buffett is all in. If a company has nowhere to grow but keeps printing money like Coca-Cola or See's Candies, then a dividend makes sense. It's that clarity of thought that makes him different. Most investors chase either growth or income. Buffett chooses both, depending on the business. That flexibility has allowed Berkshire's dividend income to grow massively in recent years without sacrificing the long-term compounding machine he's always nurtured. And this brings us to the big question. Which of these recent picks has the potential to be Buffett's next big dividend success story? Which of them might become the Coca-Cola of the next decade? Okay, so it's time to look forward. What stocks has Buffett added in the last 5 years that have the potential to become Berkshire's next dividend powerhouses or even the next Coca-Cola? One of the more intriguing additions has been Citigroup. It's been bought and sold. Berkshire's position in Citi raised a few eyebrows, but the rationale is rooted in classic Buffett thinking. The bank has a huge footprint, and while it's had its stumbles, it remains a core part of the financial system. Citi's dividend yield is 3.14%, offering Buffett another deep pocket of recurring income. While it's unlikely to become a top-tier performer like Bank of America, its current income potential is solid. If Citi stabilizes its operations, that yield could become even more valuable. There's also been a quiet but consistent accumulation in companies like T-Mobile. While not traditionally viewed as a dividend play, T-Mobile's recent moves suggest a pivot toward shareholder returns. It recently initiated a dividend and has room to grow both earnings and payouts. This could be one of Buffett's more forward-looking bets, a company that evolves into a dividend star over time, much like Apple did. Buffett's thinking around dividends isn't one-size-fits-all. He has a rule of thumb, something he's mentioned for decades.
The first question is when you have capital, is it better to keep it or return it to shareholders? It's better to return it to shareholders when you cannot create more than $1 of value with that capital.
That line is simple but powerful. It means that dividends are great when a business has no better use for its cash. But if a company can reinvest its profits wisely and generate even more value, then skipping a dividend might be the smarter move. Take See's Candies. Buffett bought it back in 1972 for $25 million. It's not flashy, it doesn't innovate, but it makes steady money. Since it doesn't need much capital to grow, the cash gets funneled straight back to Berkshire in the form of dividends. It's like a vending machine that prints bills instead of snacks. Compare that to Apple. It does pay a dividend, but its real strength is reinvestment. Apple retains about 85% of its profits, pumping that cash into research, new products, and stock buybacks, and it's working. Buffett's stake in Apple keeps growing in value, not because of big dividend checks, but because Apple keeps making itself more valuable. This is why he hasn't blinked. Even after selling a small part of his stake, the remaining shares still represent one of his smartest plays. Another standout in Buffett's recent moves is Occidental Petroleum. Berkshire owns just over 25% of the company and continues to buy. The dividend yield is modest for now, but the long-term story is compelling. Occidental has been reducing debt, ramping up production, and showing signs of increasing shareholder returns. Buffett seems to believe the future dividend stream from this energy giant could rival his biggest past winners. And let's not forget about Chevron. Berkshire has invested tens of billions into the stock, and with a yield over 4.77%, Chevron stands as a rock-solid payer. It also increases its dividends regularly, giving Buffett that beautiful blend of steady cash and growing income over time. For a man who values predictability in an unpredictable world, Chevron is a textbook Buffett pick. No one actually knows which one will be the Coca-Cola of tomorrow. It's impossible to say for certain, but the candidates are clear. Want to know how to build a dividend empire for yourself and future generations? One that can turn a $10,000 investment into a $1 million portfolio that pays over $60,000 in annual dividends? Click the video on the screen.